We have to do an illustration. Let me see where we left. Good. So now just a recap. Now let's go back to our notes. Internal rate of return. The last thing we covered was the internal rate of return, and we say that this is the rate of return where NPV is. Hey, can you go back to your notes? No, we are not writing. We had already done an introduction. Ama, class rep. Oh, this was our morning class. Ah, okay, it's okay. Now let's write. Right? Right, you see that? IRR is the rate of return. IRR is the rate of return. IRR is the rate of return where NPV it's 0, where NPV it's 0, where NPV it's 0, i.e. where present value of cash inflow is the same as present value of cash outflow, where the present value of cash inflow is the same as present value of cash outflow. Full stop. Then right, you see that? IRR is determined depending on the nature of project's cash flow. IRR is determined depending on the nature of project cash flow, nature of the project cash flow as follows. A, in case of 1 year project, in case of a 1 year project. So how do we determine IRR? So IRR, you'll take the future value divided by the present value of cash outflow minus 1. Number 2, or number B, in case of annuity cash flow to infinity. In case of annuity cash flows. In case of annuity cash flows to infinity, how do we get IRR? So IRR, A, or annuity, and by the present value of cash outflow, you multiply by 100%. And number C, in case of unequal cash flows, in case of unequal cash flows, let me say that. In this scenario, comma, trial and error method is adopted. In this scenario, trial and error method is applied. Full stop. The following steps are adopted. The following steps are adopted. Yeah, so in case of unequal cash flow, you're saying that in this case, we use the trial and error method. And what are some of the steps followed? Number one, determine the project's NPV. Determine the project's NPV using company's cost of capital. Determine the project's NPV using entity's cost of capital. Step number two. If the NPV determined above is positive, if the NPV computed above, it's positive, comma, rediscount using a higher rate, rediscount using a higher rate. If NPV computed above, it's positive, comma, recompute using a higher discounting rate, recompute using a higher discounting rate. Number three, if the NPV computed in step 1 is negative, if NPV computed in step number 1, it's negative, comma, rediscount using a lower rate, rediscount using a lower rate, rediscount using a lower rate. And lastly, number four, determine IRR, as follows. Determine IRR as follows. So IRR, you take the lower discounting rate plus NPV using the lower discounting rate divided by the NPV using the lower discounting rate minus NPV using the higher discounting rate. All of it you multiply by the higher discounting rate minus the lower discounting rate, where this means lower discounting rate. This means higher discounting rate. Now let's do an illustration. We do an illustration. Consider a project with the following cash flows. Consider a project with the following cash flows. Consider a project with the following cash flows. Following cash flow. So I have year 1, year 2, year 3. Then we have the cash flows. Year 1, we have it 60. Year 2, we have it 30. Here we have it 50. Consider a project with the following cash flow. And those are the cash flows. Then you like to say that? Please say that. If the cost of capital is 10%, if the cost of capital is 10%, if the cost of capital is 10%, and the initial investment is 100,000 shillings, and the initial investment is 100,000 shillings, comma, determine IRR of this project. Determine IRR of this project. Determine IRR of this project. Yeah, so now let's begin. So don't write, let me explain it. Now, in this case, if you look at the cash flow characteristic of this project, the cash flow are not the same. This is what you call in case of unequal cash flow. And you see that in case of unequal cash flow, we use the method of trial and error. where, what was step number 1? You determine the NPV of the project using the entity cost of capital. So we have the period, we have the cash flow, we discount. Present value interest factor. How much was the cost of capital? 10% year end. So the cash flow are not the same. We use the first table. So this is 0.9091, 8264. You have 75, 13. Now give me the present value. Give me the present value of the cash flows. Sorry? 546. 24. 792. Sorry? That's 7. 565. Good. So now let's add the total to get the present value of cash inflow. Give me the present value of cash inflows. You get 116? 9? 903. So to get NPV is the present value of cash inflow. You raise the present value of cash outflow. So how much is the initial investment of this project? 100,000. Good. So the net present value of this project will be 16,903. So what was the step number 2? Step number 2 was that if the NPV is positive, we discount using a higher rate. We discount using the higher rate. So in this case, our NPV is positive. So we need to discount now using the higher rate. Now, in our case, the cost of capital was 10%. Now, what's the objective of using a higher discounting rate? Now, the objective is to change this NPV from positive to negative. If you could have gotten a negative, you discount using a lower rate. Now, the objective is to change the NPV from negative to positive. So in this case, we use a higher discounting rate. So we have here 1, 2, 3. We have the cash flows. We are discounting now. We have 60. We have 30. We have 50. Now we use the higher rate. Present value interest factor. Which do you want us to use? And then it's a divisible. Don't use a cross figure. For example, don't use 11, don't use 12. You can use 15, you can use 20, you can use 30, you can use even 50. So can we use 20%? 20%. That's why we are saying that it's a trial and error method. Even if you use 15, the answer will be the same. So now give me that. 20% year 1. We're using the first table. 0.8333. The second one, 6944, 0.5787. Now let's get the present value. You take the cash flow, you multiply by the discounting factor. 28, 930? 935. Kindly rest stop writing. I'll give you time to write. 49, 998. 2832. Now let's add the total to get the present value of cash inflows. Sorry? 99, 765. So to get NPV, you take the present value of cash inflow, you raise the present value of cash outflow, of which the cost was 100,000. So our NPV will be negative 330, 235, 235, which is negative. Now we can compute IRR using this formula. We say that you take the raw discounting rate. In this case, our raw discounting rate was 10%. Then you add NPV using the raw discounting rate. Our raw discounting rate was 10%, of which the net present value was 16,903. You divide by NPV using the lower discounting rate, which is 16,903. Then you minus NPV using the higher discounting rate. And using the higher discounting rate was 20%, in which the NPV was negative 235. Then all of it you multiply by, you take the higher discounting rate, you deduct the lower discounting rate. Higher discounting rate we have used is 20%. The lower discounting rate was 10%. Kind of use board mass. So start with this. You take 16,903. You divide by, you open the bracket. You take 16,903. Remember, minus becomes a positive. You add 235, cross the bracket, equals. And then you multiply by 10 minus 20 minus 10 is 10. You multiply by 10. Then what you get, you add 10. What do you get? Sorry? 19.86%. So that means the internal rate of return of this project will be 19.86. You can copy now. That was part C. Now let's go to part D. We are looking at various methods of determining IRR. So number one was in case of 1 year project, in case of annuity cash flows, in case of an equal cash flow. Number C. In case of annuity cash flows, number C, it's in case of annuity cash flows for a specific period. In case of annuity cash flow for a specific period. So how do you determine IRR? So IRR is equals to annuity, sorry, not annuity, but present value of cash outflow, you divide by the annuity. Illustration. Sorry? Oh, it was D, eh? Yeah, D. You write an illustration. Let me see that. Consider the following 3 projects. Consider the following 3 projects. Consider the following 3 projects. So here we have project A, B, C. Then we have the initial investment. Then we have annual cash flows. Then we have economic period. So A, we have is 10. Here we have is 20. Here we have 15 million. Then we have the annual cash flows. Required. Determine IRR of each project. Determine IRR of each project. Determine IRR of each project. Determine IRR for each project. Good. So now let's be here. Don't write. Let me first of all illustrate. Now, as you can see, these 3 projects, if you look at their cash flow characteristics, we have the initial investment, then we have the annual cash flow. So it's an annuity, and then you are given the specific period of the cash flow. As opposed to the other question you have done, where you're given one project, but different cash flow. So this one is the same cash flow for a given period of time. So how do we determine IRR? So in case of annuity cash flow for a specific period of time, you take the present value of cash outflow, you divide by the annuity. So we have project A, B, and C. So project A, present value of cash outflow, that's the initial investment. We have is 10 million. Here we have is 20 million. And C, we have it's 15. Then you divide by the annuity. Project A, the annual cash flow you have is 2191.2. Here we have 54, 27.84. You have that 240. Now give me that into 4 decimal places. into 4 decimal places. $4.5637. Sorry. Like that. 3.647. Good. But that's not the internal rate of return. Now, project A, the economic life was 7 years. Project B was for 6 years. Project C was for 5 years. So now let's go to our annuity table. Let's go to our annuity tables. Annuity tables. Annuity table. Now let's start with A. Project A is for 7 years. Let's go to the annuity table. 7th year. Annuity table, 7th year. Now can you look across where we have 4.5637? Annuity table, 7th year. Then you look across where you have 4.5637. You get 12%. Good. We do the same for project B. Project B is for 6 years. Now let's go to the 6th year. 6th year. 6th year. Then 3.6847. 16%. C, it's for 5 years. Let's go to the 5th year. Then you can look across where you have 4.6300. 4.6300. It's not there, right? Good. It's in between what and what? It's between 2 and 3, right? Good. So that means it's between 2 and 3%. So it's 2 point something. So you need to determine that too. So it's between 2%. That's why you have IRR and 3%. So how do we get the specific? So 2% is how much? What do you have for 2%? 5.7975. 3%. 4.597. Then IRR, what we need is 4.6300. So how do we determine the specific IRR? It's between 2 and 3, so it should be 2 point something. Now this is what you do. You'll take IRR, you raise the lower limit, you divide by the upper limit minus lower limit. So you'll take IRR. The lower limit we have is 2%. The upper limit we have is 3%. So IRR, you raise the lower limit, which is 2%. Then you take the upper limit, which is 3%. You minus the lower limit, which is 2%. Now let's substitute. IRR, the specific amount we need is 4.63 euros. At 2%, the rate is the amount is 4.7135. Divide by, at 3%, the amount we have is 4.5797 minus 2% we have is 4.7135. I've just substituted the rate we have at this rate. So it will be IRR minus 2, 3 minus 2, 1. So can you compute that? $0.62. Now, can you be able to get IRR? if IRR minus 2 divided by 1 is equals to 0.62, you just need to cross multiply. So 1 times 0.62, you get 0.62 is equals to IRR minus 2. So to get IRR, you take this to the other side, so it will be positive. So 2 plus 0.62, you get 2.62%. Yeah, should be between. See, it's between 2 and 3, so it's 2 point something. So the specific rate is 2.62. You can copy now. So let's do another illustration. May 2017. May 2017, question 1B. May 2017, question 1B. May 2017, question 1B. So you're given that information, you're told that KZ Limited has the following capital structure, which is considered optimal and above the present and forecasted condition. You ignore that information. Now let's go where you have those projects just before the required. So we have project A, B, C, D, E. We have the cash outlay. We have annual net cash flows, project life in years. Then we have the internal rate of return. For the internal rate of return for project A is a question mark. B we have is 15%. C, question mark. D, 12%. E, we have 11%. Required, number 3, required number 3. The internal rate of return for project A and C. Yeah, for project A and C. First of all, you have to determine the cash flow characteristic of that project. You see, in this case, you're given the cash outlay, you're given the annual cash flows, and then their specific period. So how do we get the IRR? In case of annuity cash flow for a specific period of time, you'll take the present value of cash outflow, you divide by the annuity. So now you're computing for A and C. Project A, the initial outlay we have is 675,000. And then C, we have it 375. Then you divide by the annuity. Annual cash flow for project A, we have it 155 for 1. And then project C, we have it 161, 524. I'll give me into 4 decimal places, This one, 4.34. Sorry? Into 4 decimal places. 36, eh? 3216. Then project A, the economic life was how many years? 8 years. And project C? 3 years. Good. So now let's go to the annuity table. Annuity table. We use our annuity table. So kindly make sure you have a past paper. The past paper and the handout. Yeah, those are the key ingredients of my class, because all the illustration will be coming from the handout and the past paper. Annuity table. Now to get that 16%, you go to the AVR. Then you look across where you have 4.3436. We're getting 16%, right? Then project C was for 3 years. We go to the third year. For the third year, 2.3216. You have 14%. Good. You can copy now. So now that marks the end of the first topic, advanced capital budgeting. Now let's go to the second topic, which is related to that. That's risk analysis in capital budgeting. Risk analysis in capital budgeting. Risk analysis in capital budgeting. And this is one of the major topics. It won't miss in your exams. And also its concept is also applicable in other topics. So that means you need to understand this topic well. Now it's related to the capital budgeting. You see what we have been doing in capital budgeting for the discounting technique. We are evaluating whether to accept or reject a project, either using the profitability index, using NPV, but we are not taking into consideration the uncertainty element. You know, uncertainty gives rise to what we call the risk. So in this case, now it's all about evaluating a project, now taking into consideration the risk effect due to that uncertainty. We like to see that. Risk is a chance or probability, of unfavorable event occurring, of unfavorable event stroke outcome of unfavorable event or outcome occurring. Is a chance of unfavorable event or outcome occurring. Full stop. Then you have to see that there are two types of risks. Semicolon. A, we have financial risk. A is the financial risk. Explain to see that. These are risks associated with the use of the debt in the capital structure. These are risks associated with the use. These are risks associated with the use. These are risks associated with the use of debt in the capital structure. The use of the debt in the capital structure. Number B, we have business stroke operating stroke total risk. Right, you see that? These are risks associated. These are the risks associated with the declining earnings of the company. These are risks associated with the declining earnings of the company. Declining earnings of the company. Full stop. Then right, we see that. Business risks are classified into two. Business risks are classified into two. Roman 1, we have systematic risks, and number 2, we have unsystematic risks. Those are the two types of business or total risk. Yeah, where, don't write, Systematic risk are those risks affecting all the company in the industry or all the industry in the economy, such as inflation. And then we have unsystematic risk. They are those affecting a specific company in the industry or a specific industry in the economy. So we'll come to evaluate that in our next topic. That's portfolio theory and CAPM. So now let's look at methods of evaluating risks. Method of evaluating risks. methods of evaluating risks. Number one. So methods of evaluating risk. Number one, expected return stroke expected monetary value. Number two, standard deviation. Number two is a standard deviation. Number three, coefficient of variation. Coefficient of variation. Coefficient of variation. Number three, certainty. Certainty, yeah, that's number four. Certainty, equivalent coefficient. Certainty, equivalent coefficient. Number five, simulation analysis. Simulation analysis. Simulation analysis stroke Monte Carlo analysis. Monte Carlo analysis. Another one, decision tree analysis. Decision tree analysis. Decision tree analysis. Another one, sensitivity analysis. Sensitivity analysis. Sensitivity analysis. Another one, payback period. Payback period. Another one, beta method. Beta method, etc. Yeah, those are the key major methods used to evaluate risk. Good. So now let's start with the first one, expected return. Expected return stroke expected monetary value. Stroke expected monetary value. Stroke expected monetary value. In bracket EMV. 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 Let me see that. This is equivalent to arithmetic mean of returns. This is equivalent to arithmetic mean of returns. Equivalent to the arithmetic mean of returns also is determined as follows. It's determined as follows. So how do we get the expected return or the expected monetary value? We'll take summations of, we take the returns, you multiply by the probabilities. That's how I determine expected return or the expected monetary value. Then let you see that. The higher the EMV, the higher the EMV, the better the project. The higher the project. The higher the, sorry, the higher the EMV, the better the project. Good. Number two, that was EMV. Number two is the standard deviation. Yeah, it's denoted by that, also known as volatility. This is a symbol for standard deviation. Let me see that. This is sorry, volatility, stroke volatility. Standard deviation, this is a symbol for standard deviation. It's also known as the volatility. You see that? This is the absolute measure of risk. This is the absolute measure of risk. This is the absolute measure of risk, full stop. And you have to see that? It's computed depending with the information available. It's computed depending on the information available as follows, depending on the information available as follows. So how do we get the standard deviation? So standard deviation, take the summations of returns minus expected return square probability, then you get the square root. So this one is in presence of probability. Or to get the standard deviation, you take the summation of returns minus expected return squared, all of it n minus 1, then you get the square root. In absence of probability, where R means returns, ER means expected returns, this means summation. Number 3, we have the coefficient of variation, CV, coefficient of variation, or CV. Let us see that. This is the relative. This is the relative measure of risk. Relative measure of risk. The relative measure of risk. Full stop. Then let us see that. It shows the trade-off. Shows the trade-off between risk and returns. Shows the trade-off between risk and returns. Full stop. It's determined as follows. It's determined as follows. It's determined as follows. So how do we get the coefficient of variation? You take standard deviation, you divide by expected return, you multiply by 100%. Yeah, that's how you get CV. Remember you're saying that CV is the trade-off between the risk and the return. Remember standard deviation is the measure of risk. What about expected return? What are returns? They are the same as profit, right? So in this case, it's all about the trade-off between the risk you are taking for you to generate 1 unit of return. We like to see that. We have to see that. CV shows the amount of risk. CV shows the amount of risk taken. CV shows the amount of risk taken in order to generate 1 unit of return. Shows the amount of risk taken, in order to generate 1 unit of return, in order to generate 1 unit of return. Full stop. NB. For standard deviation and CV, comma, for standard deviation and CV, comma. The higher the values, the higher the values, the higher the risk, and vice versa. For standard deviation and CV, comma, the higher the value, the higher the risk, and vice versa. Remember, I said that they are measure of risk. So the higher the value, the higher the risk, and the vice versa. So now take out your handout. Handout question 1, page 1. Handout question 1, page 1. I had shared all the past paper in the handout to 3 WhatsApp group. And I remember I had insisted that make sure you have the handout because most of our illustrations today will come from the handout. Handout question 1, page 1. That's the past paper. You can share that. Now, this handout, the one which has page number, I have classified them per topic. For example, page 1, we have some revision question there. That's advanced capital budgeting. Then they are down still at page 1. There is now risk analysis in capital budgeting. That's the topic we are in. So you're doing that question number 1. Question number 1, page 1, under the topic of risk analysis in capital budgeting. And you're told that consider a 5-year project whose initial investment is 120 million. The annual cash flows to be generated by the project is estimated using probabilities as follows. Now in page 2. So you're given the annual cash flow. So it's an annuity. And then we have the probabilities. Then you are told that if the cost of capital is 12%, determine. If the cost of capital is 12%, determine. Number 1 is the EMV. EMV. So you see that. How do we get the EMV? Is a summation of returns you multiply by the probability. Kindly don't write. I'll give you time to write. So we are given the annual cash flows, 40, 50, and 60. Then you're given the probability. What does it mean? You're given probability because they are uncertain. That uncertainty is what gives rise to risk. For example, in this case, to get the EMV or the expected return, we have the annual cash flows. You can generate 40 million and the probability of that occurring is 0.3, or you can also generate 50 million with probability of 0.4, or you can generate 60 with probability of 0.3. So on average, how much is that? That's 12 plus 20 plus 18, that's 50, right? Yeah, so on average, per annum for the next 5 years, you'll be generating an amount of 50 million. Good. Number B of the question, number B, that was number A. Number B. NPV of the project. How do you get NPV? How do you get NPV? Present value of cash inflow, you raise the present value of cash outflow. So to get the present value of cash inflow, you already have the expected annual cash flows. So this one will act as an annuity. The project was for how many years? 5 years. How much was the cost of capital? How much is the cost of capital? So to get the present value of cash inflow, the expected cash flow, annual cash flow is 50. Then we discount. Present value interest factor of an annuity, the cost of capital is 12%, and the project is for 5 years. So 50. Now let's use the annuity table. Now get used to that table because all the other topic will be using that discounting table. 12% for 5 years using the annuity table. Sorry? Sorry? 4.8, good. So now give me the present value. You take 50, you multiply by the discounting value. $180.24 million. So that's the present value of cash inflow. To get NPV, see that you take the present value of cash inflow, you raise present value of cash outflow. How much was the initial investment of this project? 120. So our net present value will be 60.24. So that means the project is viable. Now let's measure the risk. Number C of the question. Now you have to get the standard deviation. So standard deviation, you take summations of returns minus expected return square, then you multiply by the probability of occurrence, then you get the square root. So we are given the expected returns, the cash flow to be generated. The first one was you can generate 40, you can generate 50, or you can generate 60 minus, you compare the cash flows against the average. That's the expected return. And the expected return you computed was 50. So that you get the deviation, then you square, then you multiply by the probability. What was the probability of you generating 40? 0.3. Generating 50? 0.4. Generating 60? 0.3. 10, 100, that is 30. That is 0, 10, 100. That one is that. And the total is 60. Give me the square root. So standard deviation 60, that is 7 point. Yeah, 7.75. Good. Lastly, number D, coefficient of variation. So now let's compute the coefficient of variation. Let's do it here. Now I said that coefficient of variation is a trade-off now between the returns and the risk. And how do we get CV? Is the standard deviation, you divide by expected return or the expected monetary value, you multiply by 100. Standard deviation, we have it 7.75, and the expected return, EMV, was an amount of 50. You multiply by 100%. So how much is that? 15.5%. Now, what does that mean? So that means you are taking a risk of 15.5% to generate 1 unit of return. A risk of 15.5% to generate 1 unit of return. Now, my question is, if you're told now to describe the nature of the risk, is it a high risk, moderate, or low risk? So now I want individual answers, because we have different perspective. We have risk taker, risk averse, and risk neutral. So it's either high risk, moderate, or low. What's your perspective? Low, high, sorry, moderate, high. Human lab. Low, that one you have guessed. Ruton, high, and high, Jane, high, Ida, high, Hosea, high, Row, Margaret, neutral, Valentine, still analyzing, still loading. Class rep, row, high. Okay, now let's go back. Backbenchers. High because more than the cost of capital. Does that represent the backbench or the backbenchers? By 10. What's your opinion? You say moderate, to be on the safer side. Now, you see now, in this case, we have expressed in percentage, right? Take this scenario. JM gave out a mock. and class rep scored 15.5% out of 100. How was the performance? Eh? I repeat my scenario again. JM gave out a mock and class rep scored 15.5% out of 100. How is the performance? Poor. You can't. No, I'm talking about his performance. I'm talking about his performance. No, I'm not comparing. You know, in this case, it'll be, you see, it's like you do an exam. There is no, you scored 15, you scored 80. Now I'm talking about now the class rep. That's a poor performance, right? Low performance. Okay. Have I answered your question? You see, the rate should be 100%, but you're only taking 15% for you to generate a unit of return. So that means a very low risk. Yeah, so the project is not that risk. Okay, in this case, you cannot make a comparison. It's just one project. We are making a comment based on that. The risk return trade-off. You're only taking 15%, I think it's very low. What if you get 80% or 90%? What about that? Okay, can you go back to the NB? Go back to the NB. What have I said? For standard deviation and CV, the higher the value, the higher the, and vice versa. Now, for standard deviation, in this case, you cannot comment. You cannot comment, not unless you have two projects to determine which one has the high risk, the lower risk. But in this case, it's percentage. So you can even be able to make a decision based on one project. So that means it's a very low risk. And now you can copy, now you know. Let's do another illustration. December 2013. December 2013, question 2B. December 2013, question 2B. Sorry? December 2013, question 2B. The one for Tajiri Limited. Tajiri Limited is considering investment in 3 risky projects, namely project A, B, and C. So the 3 projects are risky. The following information related to the 3 projects. So you have project A, you have project C. Let's go to the required. Required. Just before required, you're told that the company cost of capital is 14% per annum. Required. Advise Tajiri Limited on whether they should undertake the projects. So in this case, you are not to choose which one to undertake. I mean, they are not mutually exclusive. So assuming all the projects are independent, not unless we are told that is considering 3 mutually exclusive projects. Now we need to evaluate each project independently. When do you accept the project? When NPV is what? Positive. Good. So now let's start with project A. Project A. And project A, you are told that this project will require an initial investment of 50 million. The estimated the estimated annual net cash inflows over the next 5 years under the 3 states of nature are as follows. The estimated annual net cash flow, so it's an annuity, over the next 5 years under the 3 states of nature are as follows. So you have the state of nature, probability, and the amount. So first of all, determine the expected return or the expected annual cash flow. So it can either be 13,500, and the probability of that happening is 0.25. Can also either be 18 with probability of 0.5 or 20 times 0.25. So how much is on average do you expect to generate per annum? $20? It can't be 24. This is 20, this is 18, this is 13. Should be between 13 to 20. Yeah. Should be between 13 and 20. 17? 370? Yeah, 17, 375. Good. Then you are told that concerns, first of all, before we go to that, so you have these expected cash flows. So let's get the present value of cash inflow. So we'll take 17, 375, we'll discount. Now, this is the expected annual cash flow for the next 5 years. Present value interest factor of an annuity, the cost of capital is 14% for the next 5 years. 17, 375. 14% for 5 years is how much? Use the annuity table. You use the annuity table. Sorry? 4,331. So now give me the present value of cash inflow. Let's discount the expected annual cash flows. Sorry? Sorry? Yeah, 59.68. So that's the present value of cash inflow. Now let's determine the present value of cash outflow. Second paragraph. I hope you're not copying, even that for the online student. We have others who usually copy when I'm teaching. You cannot be able to copy with my speed. So kindly I'll give you time to write. Concerns have been raised about the possibility that this project will infringe on competitors' patent. If this was the case, and the competitor successfully pursue a claim for damages, the competitor may have to be paid as much as 100 million in the third year. We estimate that there is only 0.1 probability that this will happen. Read that paragraph again. Okay. So now we are determining the present value of cash outflow. Now you have been told that this project will require an initial investment of 50 million. So the initial investment of this project is 50 million. But we are told that this project is likely to infringe on competitors' what? Patent. That means we can be sued for damages. What's the probability of paying the damages? 0.1. And how much is the expected damages? 100. So we take into account the risk factor. 100 million, but the probability of occurrence is 0.1. You get an amount of 10 million. But you're not going to pay now. At the end of year 3. In this case, we are determining the present value of cash outflow. This is what you're investing now, 50 million. If you have to pay the damages, we'll only pay at the end of year 3. Now the question is, how much is the present value now? So you multiply by present value interest factor. This one is not an annuity. This will only happen or occur at the end of year 3. 14% year 3. So it will be 10 million. Now use the first table. 14% for 3 years. How much is the present value? 0.6. So that's approximately 67.50. Now add the two for you now to get the total present value of cash outflow. Get 56,750. NPV is the present value of cash inflow, which is 59,650. You minus the outflow 56,750. What do you get? 2,900 or 2.9 million. Is project A viable? Yes. After taking into consideration of the risk factor, still the NPV is positive. So that project is viable. They should undertake the project. Project B. Let's now do the same for project B. This project will require an initial outlay of 50 million spread in equal installment over the next 3 years to finance the research project. If the project is successful and there's probability of 0.5 of this happening, so probability of this being project being successful, how much? 0.5, in short is 50%. It will lead to issuance of a patent right with an estimated value at the end of year 3 years of 200 million. Now, if this project is successful, you get a patent worth how much? 200 million, but now at the end of year 3. What's the probability of this happening? 0.5. If not successful, the whole of the expenditure would have to be written off. So NPV is the present value of cash inflow, you raise present value of cash outflow. Present value of cash inflow, if the project is successful, you get a patent worth 200 million, but the probability of this happening is 0.5. Therefore, you work with how much? 100 million. But when are we expecting to get the patent? After 3 years, not for each of the 3 years, but after 3 years. So we need to discount to get the present value now. Present value interest factor, it's not an annuity, since you're going to expect at the end of year 3, 14% for year 3. So present value of cash inflow will be 100, 0.6750, you'll get 67,500. Good. Let's now get the present value of cash outflow. We have been told that this project will require initial outlay of how much? 50 million. So how much would be NPV? This is the present value of cash inflow. How much will be the present value of cash outflow? I mean, NPV. You minus what? 50. So how much would be that? 17,500. Good. Now let's read that question again. This project will require initial outlay of 50 million. That's correct. But now spread in equal installment over the next 3. We are not investing the 50 now. It will be spread over the next 3. So to get the present value of cash outflow, it's 50 million. You divide by, so how much will be investing each year? 16,667 for the next 3 years. So now the question is, how much is the present value now? You will discount. So it will be 16,667 times present value interest factor of an annuity, 14% year for the next 3 years. So it will be 16,667 times, this one is an annuity. So use the annual table because it's spread over the next 3 years. So it's each year 16,667 for the next 3 years. Sorry? 2.16. What do you get? $13,694, right? Then you multiply by 1.14. First of all, give me the answer. I'll explain why. 44,111. Why have I multiplied by 1.14? Reinvesting? No, you're not reinvesting. You're not given any project to invest. Why? Or I'm the teacher, I'm the one to tell you. Yeah, that's correct. Now, are you okay up to this point? Now, in this case, okay, how much is the cost of the project? 50. We are to invest in the next 3. Now, what you have done, this rate, you see, you're expecting that. When do we invest? At the beginning or at the end? At the beginning. Are you together? You see these cash flows, what we have done here, we're expecting at the end of year 3, or we expect to generate the cash flow at the end. But in this case, we're investing now. So let me take you back to financial management. How do we get the present value of annuity receivable or paid in advance? Receivable or payable in advance. It's, for example, how you pay rent. You have rental property. When getting the present value, you don't get the rent at the end of the month. You get at the beginning. At the beginning. So what does it mean? You'll take the formula, it's 1 minus 1 plus R raised power N over R. Now, if you do this, this is what you'll get. 2.3216. But now, we usually do add 1 plus R when the cash flow are receivable or payable in advance. Or alternatively, year 1, year 2, year 3. How much are you investing at the beginning of year 1? 16,667. Now we discount. We're investing now. How much is the present value now? That's year 0, right? At year 0, it's always 1. Are you together? Now you know, you didn't know. Now, if you use this formula, that means you're investing at the end of the year. Now the question is, if you're investing at the end of the year, how are you getting the cash flow at the end of the year? And you have just invested. When you're investing, invest at the beginning of the year, and this is how you get the present value of an annuity when the amount is receivable or payable in advance. So I've just added 1 plus R, which was 14%. Good. Now you know. Give me that. Was it 14,411? So now let's get NPV. You will take the present value of cash inflow, which was 67, 500, you minus 44,111. 23,388. Good. Last we have project C. Now is project B viable? Yes, it's viable since NPV is what? Is positive. Good. Project C. Someone is still loading that, what I have said there. You can write it at the back of your notes. No, you'll copy later. You can copy later. Let's go to project C. This project will have an initial cost of 20 million and it's expected to yield annual cash flows of 8 million in each of the first 2 years. So it's an annuity for 2 years. Thereafter, the outcome is so uncertain and no estimate can be given. This is very simple. Present value of cash inflow. How much do you expect to generate each year? 8 million for each of the first 2 years times present value interest factor of an annuity, 14% for 2 years. So it will be 8 million, 1 point, 14% year 2. 1 point. Sorry? 6.7. Now give me that. How much is the present value now? $174. That's the present value of cash inflow. To get NPV, you raise the present value of cash outflow. How much are we investing now? Yeah, this project will require a capital of 20. Give me the net present value. 60, which is negative, eh? Good. Now the question was, let's go to the required. Advise Tajiri Limited on whether they should undertake the projects above. Should they? Yeah, they should undertake project A and project A and B. So now you can copy and we can call it a day. So that's why I will proceed in our next session. So make an effort to have the hard copies for the handout and the past paper. I keep saying that is a 1 semester investment. One time, you'll not be printing them on a daily basis, only once. So someone is asking, what's the difference when the returns are realized at the end of the 3rd year and every 3 years? At the end of year 3, that's a single cash flow, only once. For every year, for 3 years, that means it's an annuity. Each year for the next 3 years.